Welcome back to Dukascopy TV. Now today marks the start of another trading week and is also an important week for the Eurozone, with a meeting on Greece, PMI and GDP data all due in the coming days. Well, with me on the line to discuss all this and more is Chief Eurozone Economist at Unicredit, Marco Valli. Marco, thanks very much for joining me today. Now there's plenty happening this week that could affect the markets. Let's look at tomorrow's meeting on Greece. I imagine you'll be keeping a close eye on this one.
Yeah, obviously this is a crucial week for Greece because tomorrow's Eurogroup meeting is going to bring some kind of solution, although probably only temporary solution, in the sense that Greece has two big problems. The first one is that if government want to give Greece two more years to meet deficit target, they have to come up with some additional resources. The second issue is that Greek debt is not sustainable. So this is a medium to longer term issue, and from here we should expect some haircut in government's exposure to Greece, which, however, is not going to come anytime soon because this is going to be a very politically sensitive move, and it's very unlikely that this will come already at this stage, given that it's still not clear to what extent that Greece will stick to the program, to the planned fiscal and structural reform. But when it comes to this week, I think that the solution will be found, although it will be mostly a temporary solution in order to provide Greece with a couple more years to meet its deficit target. And we expect that the additional resources will be found with a mix of options, which is basically allowing Greece to issue more T-bills than currently in the program. The second way to provide some relief to Greece will come from the ECB foregoing the profits of its securities and market program portfolio. So the ECB will be forgiving all the profits on its GGB holdings. And the third way to provide some relief, temporary relief to Greece, would be to retroactively reduce further the interest rate on bilateral loans.
Now, back in September, we saw the worst Eurozone PMI data for 3 months. What are you expecting from the new data on Thursday?
Well, for sure, we will get the release of the PMIs, which in the Eurozone are probably the most important soft indicators, together with the Eurocoin indicator, because it's one of the most reliable gauges of the business cycle. After several disappointing months of data, we expect some tentative improvement. So November should probably deliver some modest improvement both in the manufacturing index and the services index. Although again, both indices are going to remain well below the 50 threshold, which separates expansion from contraction. And therefore, this would remain a clear indication that GDP momentum in the final quarter of the year remain negative. Actually, following the relatively resilient number we had last week with regards to 3Q GDP, which came in at minus 0.1%, which is probably somewhat better than many had feared. Looks like in the fourth quarter the economy could weaken again further. And in our current forecast, we have penciled in a GDP reading of about minus 0.4% quarter-on-quarter. So this week's PMI should confirm that the underlying momentum will remain negative, although we do expect some signs that probably the worst part of the recession is behind us. Let's not forget that besides the PMIs, which are obviously very, very closely monitored, there is another indication in the Eurozone, which is the Eurocoin indicator, which is at least as reliable as the PMIs, as this indicator has risen modestly over the last couple of months. So we are at a stage in which it's not easy to interpret the message coming from business service and soft data in general. So we expect that while remain quite weak, the PMIs will probably start turning up a bit.
We saw preliminary German GDP data last week, which showed signs of growth in the country. What are the drivers of this expansion, do you think?
Well, I think that the drivers were mostly net exports, because exports were probably up more than imports. Then private consumption probably delivered a positive contribution. And construction investment is likely to have been up quarter on quarter. In contrast, we see some headwinds coming from inventories and particularly capex. Capex has been on a soft tone over the last few quarters, and this reflects the fact that German companies are very vulnerable to a slowdown in global trade, and obviously the last couple of quarters have seen clear signs of slowdown, both in the Eurozone among Germany's trading partners, but also in emerging countries, and particularly China. So we do expect capex to continue to shrink, although here, on a forward-looking perspective, we think that probably the worst should be left behind, in the sense that while Q4, the final quarter of the year, is still going to be quite weak, as we enter 2013, increasing signs of cyclical stabilization in China and in emerging markets in general will probably be a positive factor when it comes to investment of German firms. So overall, for the third quarter, we expect a confirmation of the preliminary 0.2% quarter-on-quarter, with consumption and net exports being the main drivers, and fixed investment, particularly capex, still a weak spot.
Okay, that's all we've got time for, I'm afraid, today. Thank you for joining me, Marco, and sharing your outlook on what data and events to keep an eye on. I'll be back tomorrow to examine the ongoing problems between Israel and Palestine in relation to oil. But for now, goodbye.